It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, national underwriter for Old Capital. And joining me today is the smartest guy in the room, Michael Becker.
Hey, Paul.
So Michael Becker, as you know, owns about 5,200 apartment units. He has probably about $500 million in real estate that he owns, him and his partners. They've collected about $110 million in equity. Mike, these stats are just unbelievable.
Big numbers all of a sudden.
25 transactions that they've purchased. They've sold 10. They have probably about 350 unique investors. And probably the best thing that I've ever seen on his property, and I think you'd love to see it, is big longhorn horns on those golf carts that you hustle people around in to see the units.
Yeah, we trademarked that. We got longhorn horns on every golf cart. You go to any one of our properties, we got jacked up golf carts and longhorns on the front.
They look pretty wild. Does that give the people kind of an impression that you guys know something about
it? Sticks out, right? So you go to all these apartments and they all kind of look the same. All the leasing carts look the same. So we have we spend an extra, couple $1,000 and we make them look a little bit nicer and it just sticks out. So it's a little thing that hopefully brands us in the mind of a resident when they're going and shopping 4 or 5 apartments on a Saturday.
It's unbelievable. You got to go take a look at those apartment golf carts. So a question that came into the podcast today is, Mike, tell me the benefits of owning apartments.
Yeah, so I think really kind of the first and foremost, what's the benefit of owning real estate in general? There's several things, and then kind of what's the apartment. So I mean, kind of real estate in general, a lot of it is just kind of having residual or passive income, get the use of leverage, have great financing available, and then obviously have some tax advantages, some depreciation, and then passive income or residual income is great. So those are kind of the main benefits of real estate. And kind of the commercial real estate world, there's really the 4 or 5 major food groups. You got apartments, you got office buildings, you got retail strip centers, you have industrial like warehouse buildings and raw land. Those are kind of the 5 major food groups. And my opinion and most people's opinion, the apartments is kind of at the top of the food chain. It's the most desirable of the other asset classes. So to kind of compare and contrast a little bit, we talk a lot about apartments, but really the other ones, starting with my least favorite, which is land. Land is very speculative. It doesn't produce any income. Unless you have maybe like agricultural land, you can rent it out or farm on it. But land has the biggest swings up and down. It's the least liquid typically. It's kind of worth what you can develop it for in most cases. And then the financing is much, much tougher on land. I mean, land, you're lucky to be able to get 50% leverage or 60% leverage on these. They typically always require some sort of personal guarantee, and they have short maturities on them. So land is my least favorite. Kind of my second least favorite is tied with office and retail. Personally, they function pretty similar in a lot of ways. So both office and retail, typically you get 3 to 5 year leases on a multi-tenant office building or retail strip center. Those typically have a little bit lower leverage. You're lucky to get 70, 75% max, where apartments you typically get up to 80. The amortizations typically are more like 20 or 25 years on the amortization, as well as you have these 2 things that are called tenant improvement allowance and leasing commissions on both of them. So both of those I don't really care for. So what that means is typically when you lease an apartment unit, you just have your on-site staff and they lease it. In a retail strip center or an office building, you typically hire a commercial broker to go out and market the property for you to the marketplace. They bring you a tenant and you're paying 6% and leasing commissions. So that's 6% of the entire life of the lease payments, monthly payments, that was all summed up, take 6%, and that's what you pay the broker for bringing you a lease. And you got to front that money, as well as when a tenant comes in the office space or the retail strip center, they want to kind of reconfigure the space, and you give them a tenant improvement allowance. So some of the older, smaller places, you might give $10 or $15 in tenant improvement allowances, but some of these bigger, nicer office buildings or strip centers, you might give $40, $50 a square foot, and those are monies that you have to front on the front end of the lease, and then you get that collected over the life of the lease payments. So it's pretty capital intensive to turn a lease over, as well as instead of in your apartment where you can turn a unit in a week, just kind of hose it down, put new flooring and paint up, and then you get a tenant in. These office spaces, typically take a lot longer to make ready, and then your vacancy between tenant to tenant tends to be quite a bit longer as well. And then industrial is probably my second favorite out of the commercial real estate behind apartments. You typically also have the 3 to 5 year lease terms, but you don't have quite as much tenant improvement allowance, and they tend to be a little bit more stable, kind of going away from the retail strip centers. A lot of that stuff's going online, so it's been pretty supportive of the industrial space.
So retail, just take a look at companies like Amazon, and they've just decimated the retail business. Is there anything you really can do about that in the retail space?
Yeah, so I think that a lot of that stuff is just if you're in the best locations, and they're kind of real estate 101, location. So if in the best locations, I think those places do well. But the suburban malls have been dying, the secondary retail strip centers have been dying. So those are some of the challenges with the other asset classes. I didn't quite, finish the thought process there. Moving to apartments, what we really like about apartments is you have the best financing available. You can get 10, 12-year fixed rate money in the mid fours as we sit today. These will go out up to 80% leverage in most cases, 30-year amortizations after typically having a couple years with interest only. And with the Fannie and Freddie Mac loans, you can get non-recourse debt. So just signing the carve-out, you don't have to sign a personal guarantee. So the government really wants to support the housing. So Fannie and Freddie are, not the only largest lenders in the single-family space, largest lenders in the multifamily space. So really the government is subsidizing a lot of the financing that goes along with it, as well as the IRS code, the way it's written now. You can depreciate a residential building over 27 and a half years. When you do a office building, retail strip center, or industrial, it's a commercial building per the IRS, so you depreciate that over 39 years. So not only do you get better tax advantages, you get better financing, and your turnover and vacancy is typically a lot smaller, and it doesn't take quite as much to release a unit out. So for all those reasons is why the apartments that have been historically and currently definitely are kind of the darling of the commercial real estate space of the food chain, I guess.
I just want to go back to that office and retail. You're typically going to have bank financing on that because Fannie Mae or Freddie Mac does not provide financing on office properties. So you typically have to go with 20 or 25 year amortizations, 5-year terms, 7-year terms. So you got to either sell the property or refinance it when it comes due. So you're not going to get the best leverage in these deals. Office is typically 70, 75. Then the same thing for retail. You're not going to get the highest leverage in these transactions. And then you got to worry about how many tenants are going to be rolling off next year, next month, 6 months from now. You just don't want to have a whole bunch of people jump out of your office or retail places. Yeah,
your banker might even make you escrow some money for TI and leasing commissions, depending on kind of the life of the expirations on your rent roll relative to their loan maturity. So those are some differences that your banker's going to look at when they're underwriting the deal.
Sounds good. So I do like apartments. We do a tremendous amount of apartment loans. And so there's specific reasons why we like it. I think we've kind of spelled it out today, why investors like investing in apartments. So what else is going on these days, Mike?
That's it. We're going to look forward to and announce here pretty soon the upcoming speaker series in the spring. Hopefully we'll have one in February, I believe, and another one in March. So stay tuned to future podcasts for that, as well as if you guys want to find out more information about Old Capital, we have a multifamily financing 101 white paper. Just go to www.oldcapitalpodcast.com. You can find that there.
And if you're an apartment nerd and you do like this podcast, make sure you tell a friend that we would love to have them as a listener. And also, too, is that if you could leave us a 5-star rating on iTunes or Stitcher, that would help too. So we definitely do appreciate that. All right, that was Michael Becker, smartest guy in the room. I'm Paul Peebles. Have a great day.